Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Morning, everyone. So NFP out today. The market was pricing in quite a large move, but we're really getting very, very little bit of a drop, a little bit of a pop, little drop again. So market really non-committal right now. We've got Trump speaking, we've got Powell speaking today. So always a chance that those are going to move markets ultimately. But right now, the market's kind of getting a little bit comfortable. I like that we saw a little bit of a divergence in terms of the S&P making a slight new low yesterday, but the VIX not making a new high. So that's called divergence. That's a good thing to see. We can see that people are really, really loaded up on hedges here. I've got a little chart to show you that. You can see right here. We got Nvidia, Tesla, Apple. S&P looks pretty similar. People really kind of pushing into those downside hedges, right? Pushing into those hedges, pushing into those hedges. Tesla, I'm not surprised. That thing looks like a real mess. But the market is generally looking like that. We have the skew really pumping up. And so what that means on the one hand, so we can take this two ways. On the one hand, you have people loading up on hedges. They haven't gotten excessively expensive. I mean, they're not cheap at all, but they're not beyond the realm of reasonable. And so people are loaded up on hedges. That makes people a little bit more comfortable being long, right? So when you see people, it's kind of like you own your house, you've got insurance on it. You're not going to lose sleep if you go on vacation. The house might burn down. It's going to be awful, but you got it covered, right? So you're able to own stocks with protection. That emboldens people to kind of stay in the market or perhaps add positions. So on the other hand, you have people really buying lots of downside puts. That puts dealers into a negative gamma position, which can create a little bit more of that dry kindling if things do want to continue down. So we're sort of seeing a little bit different, right? Zero DTE versus regular options are kind of showing some slightly different data. So it's sometimes the zero DTE can kind of skew things a little bit. So you have to really dig under the hood. But basically, people are, getting a little bit more bearish. A lot of the banks are getting quite bearish. I think for good reason. I mean, look, there is no Trump put in sight at this point, right? So Besant came out this morning or recently, and he said, there's a Trump. There may not be as much of a Trump put, but there's a Trump call, right? Meaning that over time, regulatory tailwinds and tax cuts and things like that are going to be positive, but the expiry on that call is way in the distance because that's not going to happen right now. So there's a little bit of a different in expiry there. In the short term, we're worried about that Trump put that really isn't there. He kind of doesn't care about markets at the moment. We will see how that kind of plays out. But from the point of analysts, think of what this really means to markets. You're seeing business confidence fall. You're seeing consumer confidence really plunge. You're seeing people pulling back on big purchases already. And so that's quite a negative. So you think of it from the standpoint of next earnings season. Well, where are analysts going to put their forecasts? Where are CEOs going to put their forecasts? What are they going to say in their calls? They're going to say this has been an absolute mess. And there's a bit of sort of paralysis setting in for companies because they don't like an environment where they have no clue where we're going to be in a few months, and with tariffs and all these things going on, they really don't know. It's very difficult to start new initiatives or to be confident in the future when you just sort of temporarily you're really kind of frozen, and the sort of tariff on, tariff off, full tariffs. Oh, we're easing back. We're not doing some products. It's sort of all over the place. I get the sort of overall game plan, I think, but we're sort of all over the place. So skew really pumping. I think as long as volatility is quite high, as we've got a VIX of 24, 25, I think for income strategies, what we're doing in the community and in my various programs is we're doing spreads, right? You always want to have that little piece of gamma there. You don't want to just be short leverage into this sort of hurricane. You want to have that little piece of gamma that can pay when things sort of continue to move around, because anything can happen. Look at even the generals, Netflix and Costco are starting to collapse. These are names I like. So you need to have that little extra piece of protection in there to help you out. So, but again, my focus is really starting to look at some interesting new things, and I want to show you Here's your S&P 60-minute. We're sort of bouncing our head off these shorter term moving averages, as I've been saying. We definitely have a little bit of room to the upside. So I think, ultimately in the short term, I think we can get a little bit of a bounce back here before ultimately we just have to, face the risk, which is headline risk, head on for the next few months or 6 months. I don't know how long it's going to take. But right now, if you're sort of looking for light at the end of the tunnel, you may get it from a technical standpoint and play these bounces. It's very much a trader's market. But really, from a longer term fundamental standpoint, that light at the end of the tunnel is starting to look more like the headlights of a train, an oncoming train. So, this situation is completely up in the air. This is not your usual environment. You need to really change the way you look at things. If you are trading, if you're investing, you have, especially trading, you have to really acknowledge that things have kind of changed in a somewhat durable basis. This isn't just a CPI number that missed and the market is panicking. This is durable issues being created by this backdrop. So S&P, kind of trading around that 200-day moving average. As we can see here, we've gone from upside inflation risks, which was, okay, Trump's going to be kind of inflationary. This is in December, to he's going to be inflationary. That's not great. So, but the market can handle that. It can handle a certain amount of inflation, even higher rates. They're not excessively high, really, if you look, look historically. So, the market can handle that. It can pass on increasing cost to customers. If people are starting to make more money, if there's a little bit of wage inflation, which we were seeing, then it's not really that bad a situation. But what we've really transitioned to is the second box here, which is going from this kind of, growth shock being non-existent almost, or very, very low probability, to being a very, very high probability. This is what's happening in markets. We've transitioned from this on the left to this on the right, and that's a very, very tangible problem that we're having. And what we're seeing lately is, of course, I talk about these things all the time, this sort of leveraged AUM really high coming down here, right? Because as these products are really focused in tech and mag and semiconductors, S&P products as well, they tend to create these products for areas that are fun and moving around and exciting and where people want to be. And so, they happen to be in those areas that have really been hurt lately, in those growthy areas, and those sort of, areas that have gone a little bit parabolic in some senses. In the case of semiconductors, have been struggling for a little while, but these are areas really where the AUM is focused in areas that have been really not doing very, very well. So when you get sell-offs of note, you're going to get selling from these products. They sell into selling. They buy into buying. It can go the other way as well. But on the downside, they sell into selling. And we're seeing at the end of the day, in fact, I think I have a chart here. Yeah. So here's your end of the day, mind the close, they call this. So S&P realized volatility, which means actual volatility. Look at where it's happening. It's happening massively in the last 90 minutes of the day. So the power hour, that last hour of the day between 3 and 4 Eastern, is really where there's some serious movement happening. And you have to attribute part of that to rebalancing, to some of these things, vol control funds, right? These are funds where when realized volatility, meaning actual market movement, starts to rise and get higher, they need to rebalance. They need to sell stocks. They need to sell futures. They need to sell underlying market. And you can see here that they're selling no matter what. They're selling in a down market. They're selling in an up market. They're selling all over the place. Same thing from CTAs. There's a big overhang of stock that we have to kind of chew through in this market. Doesn't mean we can't do it. That could change over the next week and a bit, but we need to chew through that systematic kind of flow, that supply of stock that is just in there. For the fact that structurally this market has gotten very, very injured. So they have to sell, right? And plus add fundamentals to it. And you've really got a backdrop where there's just a bunch of stock for sale. And we've seen, so what I'm kind of looking at is I've mentioned this before, we have a couple of years of really, really high concentration in certain, here it is right here. You can see massively concentrated in certain companies, which is really what's been driving stocks. We've seen some broadening out at times over the last 6 or 7 months. But in large part, we've sort of seen a very kind of focused market in terms of the names that people want to be in. Guess what happens after a couple of years? Well, we broaden out, right? So I know the IWM isn't doing well. The broad market isn't doing well because it's facing this growth scare, which isn't great for anybody. It's bad for the economy to worry about some of these things. In reality, that this is going to be a difficult slog, especially if things continue on the tariff, the Doge, the look at globally what's happening out there. These are not positive things, but at the same time, I think that makes things interesting from a broad standpoint. So I'm really looking at things like I'm looking at healthcare. I'm looking at areas of kind of relative safety. Not all utilities, because we have power gen in there as well. So you've got to be a little bit careful with utilities. But healthcare, Medtronic, like good quality companies, cash flow, dividends, things like that. Don't be afraid to look around. Don't just kind of keep trading the same old stuff. And then I'm definitely looking at from a tech standpoint, is Netflix tech? Yeah, I guess it kind of is, but I don't think, even in tough times, people don't get rid of their Netflix subscriptions, most people, and they don't get rid of their Costco memberships, right? They want to save money and, they got to keep watching TV, cheap entertainment. Netflix is cheap entertainment any way you look at it. So, people don't get rid of those things. So I think, there could be a little reevaluation of multiples in this market, and that's going to affect all stocks probably. So including the Netflixes and the Costcos, but those are areas that look kind of interesting to me. On the Bitcoin side of things, look at IBIT here. We've got this massive volatility risk premium. I don't know if you guys watched my video on VRP. Very, very important. It's part of my Volatility Ninja series. If you're trading options, you're trading volatility. You're trading sentiment. You're trading fear and greed. You better understand volatility. And so I've got a Volatility Ninja series that you can pick up for a joke. Here it is right here. For $47, you get my I'm going to have to raise that because I keep adding chapters and lessons to it. What an incredible series to get you on track and thinking like a pro trader from a volatility standpoint. Look at the VRP here. Options very, very expensive in the Bitcoin complex. Yeah, it's been moving around a little bit, but I took this opportunity to jump in there. Pretty decent IV percentile, kind of around the 50th percentile, and created a little bit of an income trade there. So that's part of our income program in the community, which you can become a part of in one of my programs. And we have a lot of buckets of different things that we do, a lot of things for everyone: cash machine trades, cash secured puts, cover calls. There's something for everybody in the community. So a way to be involved, but not just mindlessly doing things. I am teaching people. I am helping people. There is endless kind of teaching going on there. So those are some of the areas I'm looking at. You can see value again starting to break out. Very, very interesting movements going out there. Tectonic shifts happening in this market. So hopefully you guys got some value out of this video. We will see you in the next one. Things are in flux. Things are in motion, and we'll see you then. Bye.